This video is going to discuss how to use range bars to find very high probability trades. What we have here is a 6 pips per bar euro-dollar chart, which means basically every time the price moves 6 pips, there's a new bar, and then after it moves 6 pips, there's a new bar. It has nothing to do with time. As you can see, this is a half-hour period right here with very few bars. When the market's really trending violently here, you can see there's quite a few bars during this half-hour period and this half-hour period. During this half-hour period right here, it was pretty dead. There's only 3 bars. You know, and if you had a 5-minute chart during a 30-minute period, you would always have 6 bars there. And you wouldn't have the same kind of clarity that a range bar chart has. Also, we have a build your own trend histogram and build your own trend trailing stop, which because it's a range bar chart, if the market's going up and there's incredible strength, we're going to have a wide stop. If the market moves up statistically too much or any kind of weakness comes in, we yank the stop up and allow you to catch pretty much the majority of the trend. And, you know, traders are using these for entries and exits. When the price is underneath the hourly, it's more likely to go down. So you might have gone short here, small profit, short here, loss, short here, at 51, out at 06 for a huge 40-plus pip win. And when the currency is underneath the lower containment band, especially near the 3.0 band, which I like to color green, it typically reverses. You can see the high, it reversed, the bottom, it reversed. So when you see it come down here and the market is losing some of its weakness, you might decide to go long. Most of the time it only retraces back up to the hourly here at 55, but that's 51 pips away. You're risking 6 pips plus 1 or 2 pips padding usually on your trade. You can put your stop 1 or 2 pips underneath the swing low, and even if you're risking 10 or 12 pips, the 50 pip potential profit makes it worth your while. In this case, it had you in this trade at 02 and out at 76. You made 74 pips while risking less than 10. All of our methods apply when using range charts, just like regular charts. So most of the time, markets reverse at Fibonacci areas, especially when they're underneath the lower containment band. So you can hit Control F, draw your fibs on here. You can see the market came down to the 1.618 fib, went up, came back down again. It's losing its weakness. Another reason to go long right there. And the same exact thing, when the market's gone up and then up, usually the third or fourth wave the market reverses, so you can draw your fibs on this last little wave like this. And notice the market kind of stalls in there between the first and second fib target. Let's scroll into the future here, and you can see if you got short right here, had a small loss, short right here, pretty much break even, short right here, it pulled back 10 pips. You know, so if you lost 10 pips, broke even, made 10 pips, you pretty much broke even on that, and you can see it's incredibly strong on all time frames. Let's look at some other charts, range charts. Here's a regular 5-minute pound-dollar chart. I'm going to bring up the range chart, which I have on another part of my screen. And you can see a very similar pattern happen here. You draw your fibs on this wave here. The market came down to the lower containment bands, a 1.618 fib target, and it was also the 10 and the 20-day moving average here, and an even better pattern there with the euro-dollar. You can see a little bit of weakness, then the weakness all but falls away. It goes sideways here for about a half an hour to an hour, breaks out, and if you bought the breakout of these, hours rectangle pattern, you're in at 19. Out of this trade up here at 84, went up 60 pips. And notice the upper red, green containment band. When it goes up there and finds resistance, it's also the 50 number. The whole and half numbers tend to be resistance and support. You go short right here at 47. Pull back a little bit. If you let your trailing stop get out, you pretty much broke even. If you kind of waited a little bit longer because you see it wasn't strong anymore, it did pull back about 25 pips eventually. A lot of traders, once they find a trend, wait for a pullback and just simply buy when it breaks out and the trailing stop, gives them the entry. Here in at 85, out at 02 for 15 pips. In here at 02, out here for about 3 or 4 pips. In here, again, small profit. In here, 27, out at 47, 20 pips. And you only need 10 pips a day to double your account every 2 months. So if you have a 5 pip loss and a 10 pip win and a 20 pip win, maybe a 12 pip loss and a 7 pip win, you've made close to 20, 25 pips. That's 2.5 days minimum profit on your way to doubling your account every 2 months. Here's the Euro-Yen chart. And you can see when it's above the hourly, it's more likely to go up. When it's underneath the hourly, more likely to go down. If you just simply bought here and out, pretty much break even. In here, small profit. In here, small loss. When currencies fail to make higher highs and they come back down underneath the hourly, it's usually a pretty decent place to go short, somewhere around 45 here. You can see if you use the trailing stop to get out, you're out at 33, you made 10 pips. Came back above the hourly, went sideways right underneath the 10-day. By this breakout right here at 65, out at 95, 30 pips. In here, 86, out at 89, pretty much a break even. In here at 89, and out at 13. So the trailing stops make a great way of getting in and out of trades, and you always should use the fib targets as well. If you drew your fibs from here to here, notice it was a little bit above the 1.618. It's usually going to reverse right around there. So, rather than wait for your trailing stop to get out, as soon as it kind of stops going up and starts coming down, you might get out of this thing right around the whole number here at 110 versus 94 and capture an extra 6 pips in that particular trade. Here's the pound yen, and the currency meter also is a very good way of finding this. Right here at 6 o'clock, it became really strong. The yen was very weak. You go back to the chart after 6 o'clock, which is right here. It's just kind of going sideways right underneath the hourly. Anytime you see a sideways pattern right near the hourly and it breaks out from below to above, it tends to go up. You see the same pattern here coming down to it. Didn't bounce off the hourly like it normally does, went sideways, so it broke down right here. You're short at 95. Very, very small profit. Same exact pattern for the long side in here at 04, out at 20 for 16 pips minus your spread, and again at 29, out at 81 for about a 50 pip win. And when the currencies get at and above the white 2.0 band, you might want to wait for a little bit deeper pullback. But again, if you bought this pullback right here at 61, you're out at 70, small profit. In here, 56, out at 61, very small profit again. So to recap this lesson, using range charts, you can use our intelligent trailing stops and use our build your own trend tools to really get a clear picture. Anytime you see incredible momentum on the way up, followed by the pullback with visually half the weakness that the up move had, and notice when you bought right here, on the way back up, the strength wasn't there, so you exited this with a small profit. The pullback again, it's going sideways here, it's mostly green, breaks out, and you don't have to use a trailing stop if you just started trading around 830 right here, you put your stop underneath the lows, starts working its way up. It's not really coming down, it just broke from underneath to above the previous day's high in a 10-day moving average. Anytime you see it go sideways, just kind of move your stop up. Came up again, went sideways, you move your stop up, you move your stop up, and most of the time up at the upper containment band is going to reverse, so it's a good place to get out at 132.10. You're in this trade at around 60. That's a nice 50 pip win, even though it kind of chopped its way up there. So that's another alternative way of moving your stop up when the market's kind of chopping around choppy like this.